Well, hello, ladies and gentlemen, and welcome to today's presentation, an introduction to the vertical spreads. It's great to see you all here. Today's presentation is going to be an introduction to the components of the credit and debit spreads. We're also going to discuss using the Power Options tools to set up criteria that work best for some of these different strategies, of course. And we're also going to discuss the parity view of looking at a credit spread, analyzing its parity trade to decide which one's best for you once you've established your market sentiment and the risk-reward profile that you want to see for the given position. Now, to get started, we first want to review what is Power Options. Well, Power Options is a patented suite of search and analysis tools designed for self-directed options investors. Our tools will allow you to search across the universe of options. We support over 23 of the most commonly used options strategies. Once you've identified your positions, you can quickly do further research and analysis on the stock, index, ETF, or the various options as well. We also offer a powerful set of portfolio tools to help you paper trade, track, and manage your various options positions. And we also offer countless educational articles, help pages, archived webinars, help videos, and tutorials to help you get more familiar with the tools on the site and the various option strategies as well. And we've been in business for over 17 years. Ernie Zerrenner created the Power Options suite of tools back in 1997. But everyone here at Power Options uses these tools to trade their personal accounts, myself included, so we have many more years of combined trading experience. For those of you that don't know me, my name is Mike Chupko. I'll be your presenter this afternoon. I'm the Director of Education here at Power Options. I've had the great pleasure of working with Ernie Zerrenner and the Power Options staff for the past 11 years. I handle a lot of the coaching sessions and education for the site. I have co-authored 2 books on investing with Ernie, one on naked puts, one on protective option strategies. And I am versed in all strategies on the site as well. However, there are certain things I've never traded in my personal account, things such as short straddles and short strangles and naked calls. Well, those strategies don't match my personal risk-reward tolerance. However, when we talk about the vertical spreads, I have traded those, and we're going to show you how I approach trading the different vertical spreads today as well. Now, when we talk about the credit and debit spreads, why would an investor be interested in using one of these vertical spreads? Well, the main advantage is their leveraged positions, of course. We don't need to purchase the stock, so we're going to use less of our capital to get into a leveraged position. We have a dialed-in limited monetary risk. When we enter a vertical spread position, we know the maximum risk we can suffer going in, which will help us greatly establish our risk profile. In other words, our position size and how much we want to expose of our portfolio into this particular spread position. And of course, they also offer us the advantage of taking both bullish and bearish spreads as well. Depending on our market sentiment and where we think the market's going forward, we can play the bullish side, we can play the bearish side, or we can combine different spreads, vertical spreads, to create neutral combinations. Now, there are 2 main forms of vertical spreads, credit spreads and debit spreads. With a credit spread, we're going to sell an option and buy an option. All the vertical spreads, of course, are a combination of 2 different options. The credit spread, we receive a credit up front. The option that we sell, of course, has a higher premium. That credit that we receive is the maximum profit if everything works out the way we want to. The difference in the strike prices that we select, and we're going to sell one, and we're going to buy one at a different strike price. So the difference in the strike prices is that maximum risk. Now, depending on your broker, you may require the full amount on hold for the difference in the strike prices, but most brokers now only require the difference in the strike prices minus the net credit. So if I receive a 50-cent net credit, and I've got a $5 strike difference, a $5 spread, we'll only have to put up $4.50 to enter the trade per contract. So a 1 contract trade would be $450, and a 10 contract trade would be $4,500. For a credit spread, our main object in the position is to have both options expire worthless. So in a bull put credit spread, we want the stock to remain above both of our put strike prices. Both options expire worthless. We retain the net credit. With a bear call spread, it's a bearish position. So the position that we enter when we sell one call and buy another call at a higher strike price, we want the stock to remain below the short call so that both options expire worthless and we keep the net credit. Now, we also have debit spreads. Debit spreads, we have to pay a debit in order to enter the position. In this scenario, the option that we're buying in the combination of selling one option and buying another, the bought option is deeper in the money, so it'll have a higher cost. The most we can lose on the position is the debit that we entered into the transaction. The difference in the strike prices minus the net debit is the maximum profit. Since the debit has been paid, we don't have to have any money on hold in our account to cover the spread position. The max return is achieved if both options are in the money at expiration. Okay? We'll go through this when we go deeper into the profit and loss chart. Again, we want both options to be in the money. With a bull call debit spread, if the stock remains above both of our call strike prices, we can then sell to close one option or buy to close the other, or have our broker close that for us, and we'll receive the maximum return. With a bear put debit, similar to the bear call credit, we want the security to be below both strike prices, the put that we sold and the put that we bought. We can then close both positions or have our broker do it and receive the maximum profit for the transaction. Our four basic spreads, we have credit spreads. First one is the bull put credit spread. To enter a bull put credit spread, we're going to sell an at or out of the money put option. So if you have a stock trading at 50, we may sell the 50 put, or we may sell the 47.5 put, or the 45, for example. And then we're going to buy a put with a lower strike price. So if I sold the 50 put, I may buy a 45. We'll receive a net credit for that transaction. As long as the stock stays above 50, both puts expire worthless, and we'll keep our initial net credit. With a bear call credit spread, we're going to sell an at or out of the money call. So again, if we have a stock trading at 50, I might sell the 50 call, but more than likely I'm going to sell the 52.5 or the 55 strike call. And then I'm going to buy a deeper out of the money call, a higher strike call. So if I sold the 52.5, I might buy the 57.5 or the 55, for example. If we receive 50 cents net credit, the stock stays below 52.5, both calls expire worthless, and we keep that initial net credit. Now, the parity trade, each credit spread has a parity trade, which is a debit spread. The parity trade to the bull put is the bull call debit. So I'll use calls in combination instead of puts. Now the bull call debit spread, again, a stock at 50, I'm going to sell maybe the 50 call, and then I'm also going to buy the 45. Well, naturally the 45 is deeper in the money, so I'm going to have to pay more money. It's going to be intrinsic value plus whatever time value remains. So it's going to have a higher cost than the option that we're selling, so we're going to pay a debit. But as long as the stock stays above both call strike prices, stays above 50 again, we can close those options and get the 5-point difference in the strike prices, and that's our maximum return. And of course, the parity to the bear call credit is our bear put debit, where instead of selling the 52.5 call and buying the 55, I might sell the in the money, 52.5 put and buy the 55. And again, since the 55 put is deeper in the money, we have a higher cost. We pay a debit, so we don't have to have anything on hold in our account to cover the spread. And in the case of the bear spread, if the stock stays below 52.5, we can sell to close our 55, buy to close the 52.5. We'll receive the difference in strike prices to get the maximum return. And that usually only happens, though, if we allow our broker to do it. Let's take a quick look. And these are trades from this morning, but let's take a look at just an example of a bull put credit spread. Apple today this morning was trading at around 103.20. I want to sell a bull put spread. I'm going to look out in time, maybe within 30 days, and we want to sell an out of the money put and buy a deeper out of the money put. So we're going to look to sell 100 put, and that's $3.20 below the current stock price. We're $3.20 out of the money. We might receive $1.25. At the same time, we'll buy to open the 95 put for 35 cents. We receive a credit up front of 90 cents. That is our maximum return for the position. But remember, we have to have something on hold in our account. Our broker wants us to have something on hold in our account to cover the spread, cover our margin requirement. So the maximum risk is 410. If the stock drops below 95, we'll receive the maximum loss. Now the percent return is 22%. We're essentially looking to make 90 cents off of an investment of $410 per contract. So again, one contract, we'd have to have $410 on hold in our account. If we did 10 contracts, we'd have to have $4,010 on hold in our account, which would, of course, if we did one contract, we'd receive $90 in net credit. If we did 10, we'd receive $900 against the $4,000 we have on hold in our account. So this gives us a leveraged return of 22% for the next 30 days if the trade works out as we want. Here's your basic profit and loss chart for the bull put credit we just discussed. We're selling the 100 strike put, remember, in this example, and we'd be buying the 95. The stock stays above 100, both puts expire worthless, we keep the 90-cent net credit, and we have our 22% leverage return. Our break even at expiration, roughly 30 days out for the standard November expiration, is $99.10. Now, what would happen if the stock was trading at $99.10 at our bull put credit spread? Well, our 95 put would be out of the money, so it would still expire worthless. We won't get any value back. Our 100 strike put would be 90 cents in the money. So if we didn't want to be forced to buy shares of stock at 100, remember that's the obligation of our short put in the bull put credit spread. So if the stock's trading at $99.10 at November expiration, we could buy to close our 100 strike put for 90 cents. So that negates the initial net credit. We're essentially at a wash. But as the stock drops below that, if it's between the strike prices or if it falls and drops below 95, then we're going to have the maximum loss for the position. If the stock's trading at $90, for example, it would roughly cost us 10 points to buy to close our 100 put option, because it's now $10 in the money, and we could sell to close our 95 put for 5 points. So we'd have a loss there of 5 points between the two strike prices, but we keep the 90 cents net credit regardless. So there's our max risk of 410. That's the initial setup of a bull put credit spread. Now let's talk about the parity trade here. Let's talk about a bull called Debit. If I was interested in the position as well, we have the stock trading at 103.20. Instead of doing the put credit spread, we could enter the bull call Debit. In this case, we'd sell to open the same strike, but at the call. We'd sell a 100 call. Since it's $3.20 in the money, and we've got 30 days of time, we'd receive $4.15 per contract. But we're going to buy a 95 call, so we don't just have a naked call sitting out there, of course. We're going to buy to open the 95 call, but now this is 8 points in the money, so it's going to cost us $8.50, a little bit of time value and some intrinsic value as well. So the total net debit for the position, the $4.15 receive up front, pay out $8.50, would be $4.35. Now if the stock stays above 100, we can close both strike prices. We'll get the 5 points back, so our maximum profit would be 65 cents. $5 back in out of a $4.35 debit, we can make 65. So now the return for the debit spread is the max profit divided by our initial net debit of $4.35, so we have a 14.9% yield on the position. This looks like a similar risk-reward profile, except for we've sold the 100 call, we've bought the 95 call, so now if the stock stays above 100, we can close those positions at expiration, get close to the 5 points back, and we'll receive our 65-cent net credit. Now, in most cases with a debit spread, you want to check with your broker, but it's better to let the broker close it instead of you close it as well. As we reach Friday expiration, we'll still see that even if the stock's, let's say, still at 103.30, Apple's still at 103.30, we've got our short 100 call and our long 95 call. If I try to buy to close the 100 call, the market maker is going to force me to pay 10, 15, 20 cents. And if I try to sell to close the 95 call, he might not give me $5. He'll have a bid maybe of $4.70 and an ask of $5.10. So I'm going to have to fight with him for the midpoint prices. So I might get $4.90 for the 95 and pay 10 cents here. We get $4.80 back, so we only make 55 cents of net credit. Most brokers, if you leave this spread open, what they'll do automatically at expiration, the Saturday when the options get expired for a standard expiration or the Friday evening for the weekly series, what ends up happening is they'll automatically buy shares of stock for you at 95. We have a long call here, so that gives us the right to buy shares of stock at the strike price. We'll buy shares of stock at 95. Our broker will immediately assign them at 100 because that's the obligation of the short call of the spread. We don't change the obligation of the options we have. We just change the dynamic of the risk-reward profile by doing a vertical spread. So in this case, we'd get the full 5 points back, and we'd receive the 65-cent net credit. But it's always important to remember with the debit spread, your broker may charge you an extra commission to close that, so you have to factor that in when you're evaluating the parity trade. And again, the credit to debit parity for bullish positions, the bull put credit has the same risk-reward profile as the bull call debit. In this case, when we saw the two positions, the bull put credit on Apple this morning was giving us roughly a 22% yield, where we only saw 14.9% or a maximum return of 69 cents for the bull call debit. So in this case, if we were bullish on Apple and we had the range out of the money that we wanted for our credit spread and the probability, we'd be much better off going with the credit spread than with the debit spread. We're going to run some other examples for that as well in just a moment. But it's always important to evaluate the parity spread. Now, for bullish spreads, what do we want to look for when we're entering a bullish spread, whether a bull put credit or bull call debit? Well, the stocks, the underlying security, whether it's a stock, index, or ETF, it has to match our sentiment going forward. We want to look for positions, securities that are in an uptrend. We want to look for good fundamentals if we're evaluating a stock. For the option criteria, we want to look for a shorter time frame. It's best to go under 30 or under 45 days out in time. And of course, you can use the standard expirations, which are usually 3 weeks out in time, or the third Friday of every month. Technically is the third Saturday, but when we can trade them, it's the third Friday. Or, of course, we have the advantage of using weekly options now. There's roughly 400 plus securities that offer the weekly options. And of those 400 securities, almost all of them, about 98% of them now, offer what are known as the continuous weekly series. And we're going to take a look at that in just a moment. So you can use the standard of the weekly expirations, but we have to establish a reasonable risk versus reward for our credit spreads. We have to be a good range out of the money for a credit spread or in the money for a debit spread to have the better probability of the trade going in our direction. We want to avoid wide spreads. Okay, so a lot of securities, you can do 5-point spreads, 2.5-point spreads, you can do 10-point spreads. On the indexes, you can do 25 or 50-point spreads. The wide spreads are tricky. A, it requires more margin to be put up for the position. Yes, you might receive a higher net credit, but your return is drastically going to be lowered due to that wide spread. And also, it gives you a wider range between the two strike prices to suffer a loss. It's harder to manage, actually, as well. And of course, the shorter time frame, remember, weeklies are useful. We're going to take a look at that in a minute. But the shorter time frame is always going to be a lower credit. So you don't want to just jump into the credit spreads and say, okay, I heard somewhere out there that the weekly spreads were greatly going to increase my returns. Well, remember, in some weekly spreads, if you're looking for a high probability, you're only going to be looking at a credit of 5 or 10 cents. Depending on your account size and how much money you can allocate to the margin requirement in a credit or what you can pay for a debit, if you're only doing 5 or 6 contracts, that might not make it worthwhile long term. And we'll talk about how to evaluate that a little bit later on. And most important, for any spread, but for the bullish spreads as well, we want to avoid securities that have a pending event. Okay, we want to avoid stocks that have an earnings. You could have a bullish sentiment for the earnings coming up and say, yeah, I think the earnings are going to be very positive. This is a great time to do a bullish spread. But if there's any surprise, you could have a winning position with 3 days to expiration, earnings come out, and now all of a sudden you're at maximum loss and you had no way to adjust the position. Other events to avoid, are things such as a pending patent lawsuit, FDA approvals. Okay, biotech stocks may look like they have a great premium for a credit spread or a debit spread, but the higher net credit does not equal a better trade. Okay, so you want to make sure that you avoid some of those events going forward. There's a question that came in, Richard. Ram first asks, will a recording of this be available? Yes, I am recording this one, and we're going to record next week's as well. We'll talk about that in a little bit. Richard asks, is there any way to enlarge your web pages? I cannot read them. I'm displaying full screen on my monitor. I can't make it any larger right now. The audience view I see has the full screen up. If you have it minimized, you may be able to click in the lower left-hand corner of your screen view to increase the screen size for the GoToMeeting platform, Richard. But right now I have mine on full screen, and shows the audience view has it up on full screen as well. Okay, so let's go ahead and move on now. we're going to take a sidetrack here. We're going to talk about finding positions for the bullish spreads. We're going to set up a search in power options based on the criteria that we feel are useful, what we just discussed there. And we're also going to look at spreads one stock at a time. Okay, Ram followed up with a question. When will the recording be available? Probably 5 or 6 p.m. this evening. So we're going to look for spreads one stock at a time, and I'm going to show you how to compare the parity view as well. Okay, so let's go ahead and switch screens, and we're going to take a look at power options suite of tools. There we go. Okay, the screen's popping up. All right, now, when we look at power options, the power options suite of tools are designed by a tab navigation system. We see here that I have some basic things, the Home tab, the My Portfolio tab, and the Signature tools. We've got our strategies set up. I've got covered calls, naked puts, bull put credit, and so forth. Well, I don't see the bull call debit spread here, so we want to customize our strategy view. Let me go ahead and click on Other Strategies. This will take us to our strategy configuration. What I'm going to do is just remove everything we're not going to look at today. So let's take out covered calls and naked puts. Let's take out married puts, iron condor, and collars. We've got bull put credit. I want to go ahead and add now from our available strategies on the left. We're going to have to enter the bull call debit. And so bear call credit up as well. For later on, we're going to add the bear put debit also. Let's go ahead and save that configuration. So now we just have our spreads up at the top as well. All right, so let's go ahead and click on bull put credit. And then we see our basic profit and loss chart. We have some more detailed help information, but let's jump right in and go into the search tool. Now in power options, anytime you click the search tool on a given strategy, you're going to see some basic, here's one we were just creating the other day, but we're just going to see the basic trades that match our default criteria. To start, you can use different screens as a stepping stone. We have default searches for just initial values, bull put number 1, and weekly bull put credits. What I want to do though for this presentation is we're going to start off here in the parameter field below our results, and we're going to click clear filters. That's going to empty everything out of the filter field for our different options. The screens that we can filter by, we can look at different option criteria, things such as time frame, implied volatility, risk versus return, in the money, out of the money, and so forth. We have a variety of stock technicals we can look for, stock fundamentals, and we can even do different company lists or screen against particular company lists as well. Now to start off, remember what we just talked about. What do we want to look for? Well, we have to make sure that we're looking for stocks that match our sentiment. We're going to look here at the bull put credit spread. So let's start off in just the basic fundamentals. In some strategies, such as covered call and collar spreads, for example, the stock price is important because you know your account size and you would avoid stocks that maybe you couldn't afford, $500 stocks, $700 stocks, things of that nature. The great advantage of the spread trades with the leveraged positions is we don't have to worry about that. We're focused on the strike prices, so we can have a 5-point strike difference on a $700 stock perhaps, or maybe a 10-point strike difference, as well as a 10-point strike difference on a $100 stock. So that's not affecting us. But what are some things that are important? We want to find good stocks that have probably shown good earnings, and we want to see good liquidity on the stocks themselves, and we might want to look for stocks that are trading in an uptrend. So some of the things that I use for my personal screens is if I'm looking for stock securities, I want to look for stocks that have shown a good growth in earnings. And a good estimate or a good view to use is the percent earnings per share growth here. I'm just going to put in a value of 5% or more. I only want to see securities that have grown 5% in earnings from last year to this year. Another thing I may use for my bullish strategies is a relative PE ratio, price to earnings. I don't want it to be too far out of whack, so I'm just going to use a basic view of 0 to 50. In addition to that, when I'm looking for spread positions, especially bullish spread positions, I don't want to see anything that's a fly-by-night company or has just been released or anything of that nature. What I like to do is look for stocks that are just mid to large cap stocks. Let's hover over market capitalization. Anytime you hover over filter, it gives you a description of the basic filter and a criteria you might want to use. And here we see the mid-cap range for a mid-cap or larger stock is 2 billion to 15 billion. Since the power options filter is measured in thousands, if we wanted to look for mid-cap or larger, we're going to look for a market capitalization of 2,000 or greater. So let's just plug that in. 2,000 or greater for market cap. Now, what are the other things we want to do? Well, there are some events that happen in the market that we can't control. Things such as a buyout, just a boardroom scandal comes out over the weekend and the company fails. But there are some things we can avoid. And of course, what I want to do here in my fundamentals tab is I'm going to look at earnings, and I'm going to check the box here for not between now and expiration. I don't want to see any spreads, bull put spreads that have an earnings date between now and expiration. In the technicals field, there's a variety of different things that we can use as well. Things such as relative strength, if you use that in your analysis, Bollinger Bands, MACD even is another thing that you can use. Well, we're just going to use something simple here. In the technicals, we're just going to use the simple moving average, and I'm just going to look for stocks for my bullish positions that are trading above their 50-day moving average. If you like to use a shorter time frame, you want to see stocks that are trading above the 20-day, or stocks where the 20-day is above the 50-day. You can simply select that from the different drop-down menus there to establish the moving average you want to see. In addition to that, with using the market cap there of mid to large cap stocks, I also probably only want to see stocks that have a good average stock volume. And the average stock volume here, this is an average of the last 90 days, so I'm going to look for an average stock volume of 750 to blank. It's measured in thousands, so I'm only looking for securities that average 750,000 shares traded per day on average over the last 90 days. Now that sets up our security selection. Did we do anything that was really advanced? Not really. We told the system here we wanted to avoid securities that have earnings. We don't want any unnecessary surprises with our vertical spread. We're looking for stocks with good liquidity and market cap, mid to large cap stocks, and an average stock volume of 750,000 shares per day. We're looking for stocks in an uptrend, and we're looking for stocks with good growth. Now, what about our basic options criteria? What do we look for in a spread? When we go back into our options field, the first thing I want to do is maybe select to view options that are less than 30 or less than 45 days out in time. To start for this search, I'm just going to select standard November expiration, which is 31 days away. We'll talk about the weeklies in just a moment. Now, we saw earlier that the advantage of using the vertical spreads is for leverage. We can expect to see positions that maybe have a 10, 15, 20% return perhaps, based on the margin requirement for the spread and the net credit we receive. So I'm not going to worry about things such as implied volatility, but we are going to look for minimum net credit. And for this screen, let's just put in a minimum net credit of 50 cents. So my net credit is 0.50, and I'm going to put my percent return at least 12% to start off with. Okay? Now, the 12% I'm selecting is kind of based on the standard view of what we'd expect to see. We discussed earlier, just a brief overview of if I went a little bit out of the money, we'd receive a 50-cent net credit on a 5-point risk. In reality, that's looking to make 50 cents. We're only risking 450 because we keep the 50 cents even if the stock goes against us. So that's an 11.1% return. Okay, but I'm going to start off with a 12% return for my position. We know that we want to have positions, we want to have spreads that expire worthless. That's the goal for our bull put credit spread. So to give us a better chance of success, we're going to want our short option to be slightly out of the money. So in our in the money and out of the money fields, I'm going to look for a range, a percent out of the money of at least 3% or more. So the option that we're selling has to be at least 3% out of the money or higher, as well as still offering a credit of 50 cents and a return of 12%. In addition to that, I'm going to use the probability field. The probability, this is the theoretical probability that the stock will remain above or below a strike price on expiration. This calculation is based on looking at the past 52-week trading range of the stock, taking a standard deviation of those values, which allows us to apply a bell curve to the position. Based on that bell curve of the past trading range, we can say what is the likelihood that the stock will be at X or Y or above X or Y in the next 30 days or so. When looking at a credit spread or a debit spread, and the system knows that if I'm looking at a bull put credit spread, the probability here is looking for the probability above. Where I'm in a bear call credit spread, the system knows the probability is looking for the probability below. But in this case, we're going to start off with a probability of at least 70%. I want a 70% theoretical probability that the stock will remain above my short put strike price at expiration. In addition to that, we want to take a look at strike difference. Remember I said we wanted to avoid positions that have a wider strike difference. I do have customers, and I do have spread traders that use power options that go deep out of the money on the broad-based indexes, SPX, NDX, and so forth, and they look for 50 or 100-point spreads. I don't really recommend doing that unless you have a large amount of capital. In general, I want to start off looking for things that maybe just have a $5 strike difference or less. And when we implement some of those securities that have the weekly options, you'll even see 50-cent spreads. But what do we know about a 50-cent spread? If I sell the 100 strike put and buy the 95.50, I'm probably only receiving 4 or 5 cents of net credit. So is that really worth it? The return looks good, the margin requirement's low, but you have to trade multiple securities, multiple contracts, and then the commissions start to affect it as well. So for right now, we're just going to look for a strike difference here of less than or equal to 5. Let's keep it simple, okay? We could also just say, hey, I only want to see 5-point spreads. I only want to see 2-point spreads. That's been very common recently with the dollar strike differences I've found with multiple investors. You can set that any way you want to. We're just going to start off with less than or equal to 5. And lastly, one thing I also want to make sure is that the options I'm evaluating, I want to make sure that they have good liquidity as well. In addition to the stock having good liquidity, we want to make sure the options have good liquidity. So the option volume today, total number of contracts traded today, we may just put in a range of 10 and look for an open interest, the total number of contracts of 100. If you don't know what to put in these fields, a good rule of thumb that Ernie and I suggest is that you've probably already established a trading plan, meaning you know what return you're looking for your spreads, you know how much money you've decided to allocate from your portfolio into spread positions. Well, that's going to also dictate how many contracts you're trading. So if on average you're entering spreads with 5 contracts in each spread, a good rule of thumb is to look for an option volume today that's 5 times the average number of contracts you trade and an open interest of at least 10 times. So that would be 25 and then 50. And if you do 10 contracts, you may look for an open option volume today of at least 50 contracts and then an open interest of 100. And if you have a higher requirement, there's nothing wrong with that. You could always set an open interest to 1,000 and option volume today of greater than 100. Just look for more active options. Also, the hope is there that some of the more active options may have a lower bid-ask spread so you can get a better premium. Now, before we submit this, let's review what we just looked for and review the other slide we showed. We wanted to look for stocks where the security matches our sentiment. So we're looking for stocks that are currently in an uptrend. We want to see good liquidity and market cap. We want to avoid any upcoming events that we can, so we're going to avoid earnings. And we want to see stocks that have shown good growth as well as good management. What do we look for in the options? Well, we want to have a net credit that matches our requirement. That, of course, dictates the percent return as well based on our margin requirement. We want to be slightly out of the money. We want to look for a good probability, and we want to see some good liquidity on our options. Is this a very complex screening criteria? Not really. We've matched our time frame, what we want to see for the securities, and what we're looking for in possibly our trading plan to have a good leverage return, which is why we're looking to trade spreads to begin with. Let's go ahead and submit this open search for November expiration. All right, and we only have 3 results. As basic as that search was, we only have 3 results here. Let me just go ahead and increase this a little bit here so we can just take a view of some of this view. So the 3 results we have, let's see if that increases the size for you. Just got to refresh my screen here from GoToMeeting. But our 3 spreads that we have a spread on Apple, FedEx, and Lockheed Corporation. And again, this is pretty similar to the spread that we saw in our example from this morning. The first one, let's just look at the Apple spread. Apple is now at 103.95. We're shown that we could sell the November 100, which is about 117, but at the same time, we're going to be able to buy the November 97.5, let me scroll over here, for 66 cents. This is a 25.6% yield with a 51 cent net credit. Now, of course, what I'd have to do now, is using that more information button, We'd have to further research the stock, make sure that we're comfortable with the chart, that it's going in our desired direction. We'd want to take a look at the recent news, earnings events, and profile, make sure there's nothing out there in the news that would cause us hesitation to enter the position. And again, of course, we'd always want to evaluate the profit and loss chart for our position. Let me just go ahead and submit this again here. Sorry about that. There we go. All right, so the basic profit and loss chart, what have we done? We could potentially sell that 100 strike on Apple and buy the 97.5. Now, this is a 2.5 point spread instead of a 5 point spread. We have the probability that we want to see. And again, we see that we have a net credit of 51 cents and a potential return of 25.6. Our goal here is we need the stock to stay above 100 so that both puts would expire worthless and we'd keep the net credit. Now, there are over 4,000, close to 4,500 optionable stocks, indexes, and ETFs. Why is my research results limited? And by the way, we build about 1.2 million credit spreads every 20 minutes, every 15 minutes here at Power Options. Why do I only have 3 results? There are 2 things that we know are hindering this right now. Number 1 is the earnings date not between now and expiration. I believe Apple already had theirs, as did FedEx, and I think Lockheed had theirs also. So we're past that earnings. If I wanted to open up the screen to see more results, we could go back into the fundamentals, and we could check the box for not between now and expiration and turn that off. Let's submit that. Okay, so this only opened it up to 8 results. But now we know those other 5 results have earnings coming up between now and expiration, and we're taking the chance of a disappointment in earnings where it could fall against us, and that's not what we want to see. What is something else that might be hindering us? Well, we've seen a flux in the market. We always have to take into account what the market's doing. We've seen a flux in the market recently. Okay, it's my apologies, folks. It's October 22nd, 2014. So the last week and a half, we've seen stocks pull back drastically, but they've been coming back up nicely in the past few days. So there may not be a lot of stocks that are above the SMA 50. So I could open up my search results more by removing that, just telling the system that we're going to go back to none versus none. We're not going to use any simple moving average, and submit it. Okay, so now we have 14 results. So that's telling us that even with the increase in volatility, we're not seeing a lot of positions that are matching our return with our range out of the money. But by the way, this is a good, manageable list. This is where you want to be. And in fact, I was very comfortable with the 3 results that came up because they were stocks that were showing a strong uptrend, and they were stocks that did not have earnings between now and expiration, that had the net credit and the return that I wanted. Very quickly, let me add back in those 2 filters, not between now and expiration, and the technicals, so we see the stock trading above the 50-day moving average for our bullish spreads. Now, let's go back and let's talk about weekly series. As you know, there's a variety of weekly series that are available, and all the securities, now pretty much all the securities that offer weekly options offer what are now known as the continuous weekly series. And what that means is that you'll see 5 to 6 series in a row every week. So we'll have an expiration coming up this Friday, 3 days away, 2 days away. We'll have one 8 days out in time, 14 days out in time, 22 days out in time, 31 days out in time, which is the standard November expiration, and then we'll see ones that are 39 or 38 days out in time for the 5th week as well. So we can choose different weekly series. As you know, we talked about using a shortened time frame for your screen, that we want to be less than 30 days. Okay, if we just wanted to look for the weekly series, no problem. How would we do that? The best way to do it is we're going to change our option expiration time frame. I could choose all weeklies, but we're going to go ahead and select all months. So we're going to look at any expiration cycle that's available, but I'm going to limit my days to expiration to be between 3 days to, let's say, 9 days, or 2 to 7 days. Why am I doing that? Well, I might not want to see the ones that expire coming up on Friday. I might want to remove those from the system because there's only 2 days left, and I just want to look the next week out. It's about 10, 11 days away. No, I'm sorry, not 10, 11 days away. Yeah, it's about 10, 11 days away. Let me increase that. Let's go ahead and submit that and see what we get. No, it is 11 days. Oh, I'm sorry, folks. Let's go to 12. But, okay, what happened? We're looking for anything that expires sometime next week, okay, 11 to 12 days out of time. Why are we seeing no results? Well, it's because everything goes hand in hand. When we look for the weekly options, we shouldn't expect to see 50-cent net credits with options that are 3% out of the money. When going to the shorter time frame, we have to lower our requirements that we'd look for a 3-week or 4-week option. So we're going to have to lower our net credit to less than, let's say, or greater than 15 cents. Let's use that as a starting point. If we're looking for a minimum 12% return for a 30-day trade, I probably have to lower my expectations to maybe at least 4 or 5% for a 5 or 7-day trade. And in addition to that, the options that are at least 3 or 4% out of the money definitely aren't going to be offering us a 50-cent net credit for only a 7-day, 8-day time period, or in this case 10 or 11. So I'm going to have to lower my expectations for out of the money. Let's just go 1% out of the money, but we are going to keep our probability at 70% because the time frame is factored into that probability. We're going to leave that at 70% right now. We're going to go 1% out of the money. We've got to take our net credit down to a more reasonable expectation for our weekly series. All right, let's go ahead and run that search. Okay, and now we see we have 5 results for this weekly series. FedEx is in there as well. Well, we know they've already had earnings. We saw it before. Apple's in there. Nike's in there now, but we probably didn't see that one in the standard search simply because earnings are probably coming out for Nike sometime between after next week's expiration and the standard November cycle. So it's important to keep in mind, once again, that everything goes hand in hand. That if you want to use a weekly series, you can still look for probabilities of 70, 75, or 80% or higher, but you're going to have to lower your requirement for minimum net credit and lower your range out of the money. You're not going to be able to find positions, whether weekly or even standard expiration, that have a 90 or 95% probability and still offer a 25 or 30% leverage return. If they're there, this tool will find them. However, that's not what you're going to expect to see. Okay, so that's just for the bull put credit. Now, I'm not going to spend much time on this because we want to talk about our bearish positions, but for the bull put credit spread search, we do the same thing. We look for the same criteria. The only difference now is that you're going to adjust slightly. Instead of looking for a net credit, you're going to put in your net debit. So again, you can use our default criteria as a stepping stone. And take a look here. We have got some of the same filters. We're looking for stocks that are trading in an uptrend. Want a good average stock volume on the default screen. We want stocks that have shown good earnings. That's the criteria you want to see in any bullish position, even just a covered call or a collar. But then, of course, we're going to want to look for positions. This is the weekly screen. Again, we're 2 to 10 days out in time. Now, though, instead of being out of the money, remember, with our debit spread, we want to be in the money, all right, to get that probability of greater than 70%. We want to see some liquidity and open interest. And, of course, you can set your strike difference any way you want to. All right, let me go ahead and adjust that. So the strike difference is greater than 1 in this case. We're avoiding the 1 strike differences and looking for anything higher. That's great. But here, of course, if you wanted to establish a net credit, you could just put that in. That's the net debit field. And then your percent return, we could adjust this as well. So if we wanted to go a little bit higher, we'll just change that to 3 and submit the search. Okay, so now we have our view here. We have Facebook position, Celgene, and Apple again. Well, we saw some other positions with Apple, and I'm going to look at the Celgene position real quick. And this is a weekly, October. So next week, October 31st, Happy Halloween expiration. And Celgene's at 95.17. We're looking at a 2-point spread. We could sell, remember, an in-the-money call now, or $3.17 in the money. We could sell that for $4.05. And then we buy the 90 call for $5.80. All right, so this would be a net debit of $1.75, but if we close the position out, we'll get 25 cents, right? So we can close it out, get our 2 points back, we'd make 25 cents, and this would be a 14.3% return. Now, before I entered this trade, after I looked at the stock chart, the company information, I decided this is a good position I want to enter. I like the return. Before I enter that debit spread, what I want to do is I'm going to link over to what we call the midpoint spread chain tool, or the spread chain tool. And what I want to see here is this gives me the ability to look at credit spreads, debit spreads, or the put credit call debit parity. Let me just change this a little bit. I'm going to put that back to 70. Yeah, okay, let's just do that. Let me submit that again, sorry. Okay. So the put credit and call debit parity. On the left is our bull call debit spread that we were evaluating. Remember, we were going to sell the 92 call and buy the 90. This time, using the midpoint pricing, we'd have to pay a debit of 154 using the midpoint. So we pay out 154, but if the stock stays above 92, we can close out both options. We would then sell to close the 90, buy to close the 92, and we should get roughly close to 2 points back. Or again, we could allow our broker to do it. When we get the 2 points back with a $1.54 debit entered, we have a max profit of 46 cents in this case, and that would yield with the midpoint a 29.9% return for the bull call debit spread. Now on the right, in our spread chain view, I'm looking at put credit and call debit parity. Using the midpoints, the net credit for selling that 92 put and buying the 90, same risk-reward profile, but the midpoint only gives us a net credit of 36 cents. So the max return would be 36 against a risk of 164 now, so that's a 22% yield. So unlike the Apple example we saw in the beginning of the slides, in this case, I'm going to be much more likely to go with the bull call debit spread. It has the same risk reward. The maximum return occurs if the stock is above 92 for the bull put or the bull call. That's our maximum. And then we realize the maximum loss if the stock's trading below 90. Here's our 90 strike. Okay, so we have the similar risk reward profile, but in this case, if we get the midpoint pricing, we're going to have a much higher return for our debit spread than we would for the credit. So in this case, I want to stay with the credit spread. I'm sorry, stay with the debit spread. However, you always want to evaluate. If you decided you like the credit spread, you always want to evaluate this parity view to make sure you're selecting the trade with a similar risk-reward profile that gives you the best bang for your buck. Now, I know many of you are just interested in credit spreads. Many investors I talk to, they just want the credit up front. They want to see that in their account. They're not overly concerned if the debit spread does have a higher return. Because remember, if I'm only doing one contract of both options, okay, so one contract of the bull call debit, one contract of the bull put credit spread, there's a 10-cent difference here in profit. So the bull put is giving us a 46 cents maximum return. The bull put credit is 36. Okay, so there's a difference there. When I enter the spread, if I did just one contract, I'd get $46 for the bull call and $36 for the bull put. If my commissions are $10, well, it's 36 and 26 now. So minus 10 for commissions on both sides. We now have 26 and 36. But depending on your broker, remember, in order to get the full return on the bull call debit or the debit spread, you have to actively close those legs, or your broker has to close them for you. If your broker charges you another 10-cent commission, doesn't charge you anything for allowing the options to expire, now we're even. Okay, so the second commission to close in the bull call, we're both at 26. Okay, and as of course you enter multiple contracts, you'll be able to do the math above that. But remember, you're going to have to pay something to close the debit spread. However, if your commissions are, of course, lower, and your broker only charges you maybe a portion to close a debit spread, let's say they only charge you $4.50 or $5, the debit spread still looks better. So you want to make sure you compare the money. Now that's a very base example with one, with one contract. The same thing, if we were doing 10 contracts, remember 46 cents versus 36 cents. If we did 10 contracts, well, we'd get $460 here and $360 for the bull put using the midpoint, minus $10 commission at entry for both, so we're looking at $450 and $350. And then, of course, if we have to close the debit spread, and our commissions again are $10 to close that, we're still at $450 to $350, so it's still more advantageous monetarily to enter the debit spread as opposed to the credit spread. Okay, so that's how we evaluate the parity view. We can go in the spread chain, and we can look at the put credit versus call debit parity, or the call credit versus put debit parity, and you always want to make sure you evaluate that before you look at a new position. Okay, now, with that being said, in the introduction to call put debit, let's go back to our slides real quick. And let's talk about our bearish spreads. Bearish spreads allow us, of course, to take advantage of a bearish market without the exposure of a naked call or an in-the-money naked put position. Bear call credit, the first one of our view, and the credit spread, just the reverse of what we do in a bull put credit. We're going to use calls, of course, instead of puts. Apple again at 103.20. Remember, on our bull put credit, we were looking at selling the 100 and buying the 95. We want it to be out of the money to have a good probability. For a bear call credit, I want to sell the out of the money call, a call that's above the current stock price. So we might look to sell the 105. In this case, this morning it was at 145. And we're going to buy to open the 110. Okay, so higher out of the money, deeper out of the money, higher strike price. So it's only going to cost us 35 cents. We're going to have a lower cost to buy the out of the money call. Our net credit, in this case, would be 110. And the maximum risk, once more, is that difference in strike prices are 5 points minus 110. So we have maximum risk of 390, and the percent return would be about 28%. All right, so here's our risk-reward profile, that potential bear call credit spread we saw this morning. Once again, we're selling here the 105, and we're buying the 110. So that the 110 is the option that we're buying. As long as the stock stays below 105 at expiration, both calls expire worthless, just like an out-of-the-money covered call. And we keep our original net credit of 110. If the stock is at 106.10, we sold the 105, the stock's at 106.10, our break-even at expiration, what would happen? Well, we'd have to pay $1.10 to cancel our obligation. Remember, that short call obligates us to deliver shares of stock, in this case that we don't own, at 105. So the stock's at 106.10. We're going to get assigned at 105. Our broker may go out, buy shares of stock at 106.10 and sell them at 105. There's the 110 difference. Or we could buy to close it for maybe 110, 115, 120 prior to expiration. So that's the break even. And the full loss, again, is realized if the stock's above our higher strike price call. If the stock's above the higher call that we buy in a bear call credit, or if it's below the lower put that we buy in the bull put credit, that's when we receive our maximum loss. We'd have to pay 5 points to close the position, but again, we keep that initial credit, in this case of 110, so our maximum loss is 390. With the leverage, remember, it works both ways, so we are risking 100% of that 390 that we'd put into the position. And that's for one contract, remember. So we did 10 contracts, we'd have to put up $3,900 to make $1,100. It would just increase everything by a factor of 10. Now, parity trade is the bear put debit. And we would look to evaluate if I was really interested in selling that bear call on Apple by selling the 105 and buying the 110, I'd want to compare it to the bear put debit, where I'd use the same strikes, but just use puts. We'd sell the 105 put, which is $1.80 in the money, and we'd receive $3.30. At the same time, we'd buy the 110 put. We'd buy the 110 put at $4.70. Oh, I'm sorry, that's supposed to be $7.70. My apologies. That's $7.70. I was wondering why that looked wrong. So this would be, it was $7.30. I'm sorry, it'd be $7.30. Wow. Thought I had copied that over correctly. It looks like it didn't. All right, so it'd be $7.30 for the put, right? Because we're roughly $6.80 in the money, so you have an extra 50 cents of time premium, so this would be $7.30. So the net debit's true. So we have $4 net debit to enter the position. And again, if the stock stays below 105, we can close out our two puts, get the $5 back, and that would be a max profit of $1. We paid 4 in, can potentially get 5 back. That's $1 or 25%. Remember the previous position, however, that was at a 28.2% yield, maximum return of 110 as opposed to $1. So in this example, we're still receiving more for the credit spread, and we wouldn't have to pay an extra commission to close out the debit spread. So in this case, it looks like the credit spread would be a much better trade. But again, profit and loss chart, same risk-reward profile. The stock's below 105 for our bear put debit. We receive the maximum return for the position. Maximum loss is realized if the stock is above our bought option in the vertical spread, in this case above 110. What would happen here? Well, instead of the options being in the money where we saw with the bear call spread, and we'd have to pay $5 to close out those calls and take our loss of $3.90. In this case, if the stock's above 110 on our debit spread, well, both puts would now be out of the money. They would expire worthless, which is not what we want, and we lose the $4 that we invested into the position. Remember, the debit we paid out, so if the stock goes against us in the case of the bear put and is trading above our our long put strike price, both puts expire, we lose the $4 that we invested into the position. Okay, so we see the same risk-reward profile. Again, the credit spread might give you a higher return, or the debit spread might give you a higher return. You always want to compare the parity trade before you enter the position after you've done the research and analysis on the stock and on the option. Okay, so for bearish spreads, what do we look for? Well, we want to look for stocks with bearish criteria. Okay, we may look for stocks that are in a downtrend, stocks where the signal line or the MACD has dropped below, or the MACD has dropped below the signal line. We also still want to keep the same thing. We want to look for a shorter time frame. You know, if we receive a premium, a credit, or the return for a debit month by month by month, we'll have a higher annualized return than if we entered a credit or a debit spread that's 5, 6, 8 months out in time. Plus, it's also easier to manage in the shorter time frames because you have more opportunities to roll or adjust the position to in the nearer term. If I do a debit or credit spread that's 6 months out and it starts to go against me, I may be hard-pressed to find options that are further out unless it offers leaps. There might not be an 8-month out or a 10-month out option where I could try to adjust the position for a credit. We're going to be covering that in next week's presentation. Just as before, we always want to establish a reasonable risk-reward. We want to be a good range out of the money for the bear call or in the money for the bear put debit. We want to have a reasonable probability of success. I prefer to avoid wide spreads, and we want to be in that shorter time frame. And very similar to what we saw before, we want to make sure that we avoid those events. Let's briefly now jump over back into power options. Let's take a look at our bear call credit, set some basic criteria from scratch, and see what we can find. All right, so we're back in that spread chain tool, but before we go back into the spread chain tool to compare the parity, I want to go to bear call credit, and we're going to go directly into the search. Okay, so here again with our default screen, we have a few results here that match our criteria. But for the bear, there we go. Let's go back into bear call. I don't know why that switched over. Let's make sure we're in bear call. Fantastic. A lot of lists here. This is a default search again I've created. But again, want to make sure that once you've created a search, you can save it so you can always see it there. You can use the default screens as a stepping stone. We can pull up weekly bear call credits. And we see the potential positions. We have 141 total results that match this base default criteria. Well, that's too much. Let's again review what criteria you might want to look for when analyzing a bear call credit. Let me clear the filters. I'm going to wipe that out from scratch. This time, let's start off with our options criteria, because the options criteria used for a bear call credit are not going to be much different from the bull put credit. The system knows what it means to be out of the money in a bear call and out of the money in a bull put. And when the bull put, when we wanted a probability, the system knows that's probability above. We're in a bear call, the system knows it's probability below. We want to look for the same thing. Once again, I'm going to start off with static November, standard November expiration, but we'll go back and look at weeklies as well. My net credit, let's keep that where we were before with our bull put credit for the standard expiration. We're going to put that at 15 cents. Let's go 11.5% with our return. For our range out of the money, I want to start off with my short call option at least 3% out of the money or more. Kind of keep the same strike difference. I want to have a strike difference of less than or equal to 5 points. But you can adjust this to your own needs. We're just showing the functionality here and some guides for what you might want to use if you're just getting started out with the spread positions. Probability, let's keep that at 70% or higher. And I do want to see some liquidity in the options. I want to make sure that they're actively traded. So I'm going to use, again, option volume today of at least 10 and an open interest of at least 100. Now, for this screen, we can go into the fundamentals, but I don't necessarily want to see mid to large cap stocks. Okay, we could use that if we have a bearish sentiment. I don't want to look for stocks that have good earnings necessarily. I don't want to see growth stocks. So what I'm going to do is simply just look for a position here that does not have an earnings date between now and expiration. We could choose to look specifically for small cap stocks if we wanted to, but we're going to avoid that for now. We're going to get a little more advanced here with our bear calls. We're going to go into the technicals. And for the average stock volume in this case, I may want to look for stocks, instead of looking for stocks greater than 750,000 shares on average per day, may want to look for stocks that have less than 750,000 shares on average traded per day, lower volume stocks. We might use RSI as well, but in this case we're going to use a simple moving average. I'm going to look for a stock price to start off with that's less than the SMA 50. We're going to look for stocks that are trading in a downtrend. So I'm just going to use that as a starting point. We could also use things such as broker recommendation, but we're just going to start off with that. So again, we've got our options criteria, same as we looked before. In fact, whether it's a bull put or a bear call doesn't probably change your trading plan. You have a minimum requirement for net credit and minimum return. You want to be a decent range out of the money with your short call for the bear call credit or the short put for the bull put credit. You're going to want to start off looking for a good probability, and we want to see stocks that are in a downtrend. And always, whether it's bullish or bearish, you want to avoid the surprises. You still want to do the research and make sure there's no events coming up, but you want to avoid stocks that have earnings between now and expiration. Let's go ahead and run that search. See what we get for November expiration. Wow, once again, we've got some indexes here. We didn't have any stock securities that matched our criteria, that are trading below their 50-day moving average, have a low stock volume, but still had the probability and net credit. Now, this is correct. This isn't an error. As I mentioned, we're building 1.2 million positions there. So one of the things, let's go ahead back into fundamentals here. Let me just take out the average stock volume requirement, see what we get. Let's open this up. There we go. See, now we've got some more in there. But the stocks that were trading with less than 750,000 shares apparently didn't match our probability and our return. So when you start to create a search and you have a limited number of results, remember to start opening it up more. But if you have too many results, you're going to want to increase maybe the net credit or the probability to continue to lower your results to a nice, manageable list. Okay, so we know that Netflix had a terrible earnings. I believe they dropped over 22% recently. But here we see with Netflix at 380, stock has jumped up today. But we could potentially sell the November 400 strike, 30 days out for 670, buy the 405 for 550. Here's a net credit of $1.20 on a 5-point risk, so it's a 31.6% return. Now, what's my next step? Well, if I was interested in this return, I thought these were the positions I wanted. First thing I'm going to do is take a look here at Netflix. I'm going to look at the stock chart, make sure it's going in the trend that I want. I want to take a look at the company news. I want to make sure that there's nothing really positive coming out about Netflix. It doesn't look like there was, even though it's recovered 14, 15 points today. But these are the things you want to know. You want to do your due diligence to make sure the security is going in the direction you want for a bearish spread or for a bullish spread. And after I've done my research and analysis, remember what we want to do is we want to take a look at the midpoint spread chain. I know my bear call credit's offering about a 31.6% static return. We're going to link over here to our position. Oh, I've got to change this a little bit. That was a 5-point spread, so I've got to make sure I have the right value there. Probability of 70. Let me submit that. So we're in the call credit and put debit parity. Now, as you can see, for a highlight, the position highlighted in red is the spread we were evaluating on the search tool, the Netflix spread that matched our criteria. In this case, for the bear call, we'd sell the 400 and buy the 405. Using the midpoint pricing, the net credit actually jumps a little bit to $1.24 to a 33% yield. Okay, remember up here at the top, let me just go to that very quickly. In the spread chain view up here at the top, we're selling the 400. That's the strike we're selling. We're buying the 405. Our goal is to have the stock remain below 400 so that both calls expire worthless. We keep our net credit of $1.24, which is roughly a 33% return based on our margin requirement. Now, the debit spread, if we sold the 400 call and bought the 405, we'd now have a debit of 383. Well, for our 5-point spread, again, if the stock stays below 500, we'd be able to close both legs, get the 5 points back, and that would be a total return of $1.17, which is only 30.5%. And remember, for the debit spread, you have to pay the extra commission to close out the spread. So here, If I was interested in Netflix, I was interested in doing a bearish position on Netflix. The 400-405 spread is what I was interested in based on probability in this case, 73.8% as well. Now, I'm sorry, 73.8% that it would be below 400 at expiration. So in this case, the credit spread is far more favorable. But another thing, now that I've done my research and analysis, if I think that Netflix has been a little bit too wonky and that I'm worried about this 400, the stock might come back up. Now it's at 376.27. Now that we know that, we can still find good returns. Let's look further down. We have almost a 20% yield using the 410, 415. Let's go ahead and do that. I'm using the 410, 415, and it's still a 19% yield, a net credit of 83 cents. And we still have the probability we want. Now that would have appeared in our search results. So if we go back to our bear call credit, we can see it here further down. It doesn't have as high a return, right? We chose to sort our results by the highest return, but here's that other spread that now has that higher probability that we're looking for. Okay? Once again, let's take our bear call spread criteria that we use. We look for stocks in a downtrend, and we wanted to avoid stocks between now and expiration. But let's change this to the weekly series. Instead of looking at standard November expiration, I'll choose all months again. And we'll change our days to expiration 2 to 10 to focus it just in the next 7 days. Let's go ahead and submit that. Okay, and in this case, we see one of our the Brazilian ETF has multiple strikes that do match that criteria we wouldn't expect to see. Remember, we didn't change in this case, as we did with the bull puts. We left our net credit at 50 cents with an 11.5% return and a 70% probability. Well, in this case, Tesla's still there, highly volatile, bouncing all over the place, might be a good bear call spread, very lucrative, might go against you very quickly. It's hard to tell with Tesla. So these might be positions. I'd have to do further research on the Brazilian ETF to see its range, how it's been trading. Is it comfortable enough for me to enter a bear call credit spread? I mean, if this security, this ETF has been bouncing from 50 down to 35, up to 48, then back down to 45, down to 41, up to 43, might not be something that I feel very comfortable entering a bear call or a bull put credit spread in. And that's why we want to take a look at the chart and make sure the stock's following our sentiment for that position. And then once we evaluate it, we want to make sure that this is the position that we want and has the probability we want as well. One more quick thing I'm going to cover while we're on the search screen. Let me clear the filters. One thing that we do recommend here, for those of you just getting started in credit spreads and debit spreads, rather than trying to evaluate the securities, which are more volatile, you may be better off looking for spread positions on just the broad-based indexes and ETFs. We do have sample searches set up for you in every screen. If you go into the sample search view, you'll see screens for ETF and index, a sample screen, a sample search criteria that you can use as a stepping stone. But while we're here today, let's go back to that search for bear call credits. Let me clear the filters out here. And let's look at a weekly series. Okay, so we're going to do all months once more. We're going to go 2 to 9. And we're going to keep some of our weekly criteria that we'd expect to see. We're going to look for a net credit of only 15 cents or more. We're going to look for a percent return of about 5% or more. We're only going to want to be 1% out of the money to start with. We're still going to keep our probability 70% or more. Then we want a probability, theoretical probability that the security would stay below our short call strike price. And in addition to that, we want to look for some basic, the strike difference, I'm sorry. I'm going to keep mine less than or equal to 5 for the time being. Option volume today, let's put in at least 10 contracts, open interest of 100. But now, if I do have a requirement where I just want to look for indexes and ETFs, or maybe I just want to look for stocks in the S&P 500 or S&P 5-star lists, we'll go into the lists field, and we can include or exclude a specific sector or industry, but we want to focus on the stock list. We can include or exclude a specific stock list. So in my stock lists, I'm just going to select the drop down here for indexes and ETFs. I only want to see bear calls in my indexes and ETFs. Sorry, I forgot one thing, folks. Let's go back to technicals, and I am going to look for securities that are in a downtrend. So once more, on our simple moving average field in the technicals, stock price less than the SMA 50. Let's go ahead and submit that search now. Ooh, okay. It's got to go to 10. There we go. Okay, it's 9 days out. Okay, so we've got some SPY positions. We've got some SPX positions, XOP as well, QQQ, very good. So we've got some decent bear call credit spreads. We have a bearish sentiment of the market over the next 9 days. But 98 results, that's a little bit too much for my tastes. And I don't see anyone's here, but I want to make sure of something else. If I'm running a screen for spreads and indexes and ETFs, I want to make sure personally, you may have your own ideas and you may have your own preferences. What I want to do is I'm going to avoid the leveraged ETFs. Okay, I don't want to see the 2 times and 3 times bull and bear ETFs because they can move more quickly, and even though you have a high probability, they can run against you faster and cause you to suffer a loss. So I'm going to make sure that we select to exclude the leveraged ETFs. Let's submit that. All right, so that took us down to 91 results. Okay, so I still think this is too many. All right, I want a nice, manageable list of maybe 25 to 30 bear call spreads. What are some of the things I might do now to further restrict my risk versus reward? Well, if we're comfortable with spreads that are offering a 70% probability and offering a 15-cent net credit, I'm probably also comfortable with positions that might have a 75% probability with a 15-cent net credit. So let's just change slightly our probability and hit submit. We've narrowed it down to 58. Okay, that's pretty reasonable, but most of the net credits here are pretty high, 45, 50, 20, 21. So maybe now, I know I can still find reasonable premiums with 75% probability. Let me look for the better ones by going with a 20-cent net credit. Let's submit that. That's better, 41 results. So now this is a nice, manageable list. We do have some duplicates, of course. And if we wanted to avoid the duplicates, and just what I mean by duplicates here, we see the first 2 positions, 2 or 3 positions are both on EWZ, that Brazil index against the banking index for Brazil, MSCI Brazil Index ETF. There's a couple on SPY, there's one on IWM and SPX. Well, if you just wanted to see the one that offered the highest return, or however you chose to sort your results by, do you have another filter for here we can use? Down in the price strike price, you have a checkbox for 1 result per security. So let me add that and go ahead and click submit. So still keep the spreads that we want, but it narrowed it down. So we just have the highest return SPY, EWZ, SPX, IWM, QQQ, XOP, GLD, the gold ETF, and DIA, the Diamond Holders Trust as well. So this is a nice, manageable list where now we can look at the security chart, any information. Of course, most of the ETFs, you won't see a lot of company news or information. You're really looking at the chart and the technicals and fundamentals of those securities. But remember, before I choose the bear call credit, after I decide that I'm bearish in the market as a whole, this is a good spread I want to see. You always want to go to that midpoint spread chain and compare your parity trade as well. Well, we just have a few more slides here to wrap up, folks. We're going to switch back over. And we just want to talk about the final thoughts for the spreads. If you guys have any questions here, we're about 15 minutes past, but if you have any questions, go ahead and use the question pod there to send it to us about the vertical spreads. So our final thoughts for the spreads: security selection. Make sure the stock or the index or ETF matches the sentiment for the position. If we're bullish, we're doing a bull put spread, bull put credit spread, excuse me, or a bull call debit spread. Make sure you're looking for stocks that have a reasonable trend and maybe have a good earnings per share growth, show good management, good average stock volume, maybe a mid to large cap stock setting as well, market cap. Make sure you're looking for good, strong companies as well. Avoid securities with the upcoming events. We want to avoid securities that have an earnings coming up between now and the expiration of our spread position. If there's anything in the recent news that shows us a pending patent lawsuit, a pending FDA approval, or anything along those lines, that's something we want to avoid. Sure, those securities, those biotechs that have an FDA phase 2 or phase 3 trial coming up might have a really enriched premium and really high implied volatility. But these are also the securities that could gap up 50 or 60% with approval in an FDA phase 2 or phase 3 trial, or they could drop 80% trading halted, and as soon as it starts again, it's down from $8 to $1 per share. Your spread is probably wiped out completely and you're at full loss. So remove volatile securities. You can filter by volatility as well. But you also may want to remove those leveraged ETFs, those 2 times and 3 times ETFs, unless you become really familiar with how they move and what you'd want to look for. And remember, with spreads, just like any other strategy, the highest net credit is not necessarily the best trade. Now, for the options, look for an appropriate time frame that matches your trading plan. Spreads are best used if they're under 30 days out in time. You want to look for a reasonable risk versus reward. Okay, a 90% probability of expiring worthless for a credit spread, you can't expect a 25% return. If those spreads exist, the power options tools will find them. Okay, criteria go hand in hand. We saw that with the bull put credit spread. We were looking for a 50-cent net credit and a 12% return with a 70% probability for a 30-day trade. When we shortened it to 9 days out in time, we didn't find any results because we had to make an adjustment. If we're going shorter time frame, we've got to adjust our net credit down, maybe adjust our return down a little bit as well, but the probability you can keep also. Now remember, we want to see some liquidity. You don't want options that haven't had any open interest, that no one's trading because you're fighting for the market maker to get the best price. He's probably always going to win. So make sure you have some good liquidity for the option that you're selling and for the open interest as well. And last but not least, always evaluate the parity. Make sure you're getting the best trade for your sentiment. If you found a good bear call credit spread on an index or ETF, neutral to bearish position, and you've got a good return, compare it to that bear put debit spread using the same strikes but using the puts to see if you can get more bang for your buck. Honestly, if it's only 2 to 3 or maybe 5 cents difference, depending on how many contracts you're trading, even if the debit spread has a 5-cent higher net credit, that's probably not going to be better over time. I'm sorry, to expiration. That's probably not going to be better to expiration because you're going to have to pay that extra commission to close it out. So the 2, 3, 5 cents is probably not going to be better for the debit spread as opposed to the credit spread. Yeah, the broker's going to need to close it, so you're always going to have that extra commission cost as well. So this is just what we wanted to cover today with the basic introduction to the vertical spreads, bear call credits, bull put credits, bull call debits, and bear put debits. Next Wednesday, October 29th at 12 p.m. Eastern Time, we're going to talk about managing and adjusting your credit spread positions. The follow-up to today's presentation, we're going to use the Power Options portfolio tools to track these vertical spreads, and of course, deep discussion into the different management techniques that investors use to manage a spread once it gets in trouble. I'm going to try to, oops, sorry folks, I don't know if I can do that here. Can I copy that there? No, hold on, let me just go back one more. All right, sorry about that. Let's just do this. Sorry folks, I'm just trying to copy that link. I'm going to send it to everyone in the chat window so you can see it. Maybe you can copy that as well. That's the registration for next week's presentation on the management techniques for the vertical spreads. So we're going to discuss next week, next Wednesday at 12 noon Eastern Time. And of course, you can also register for that anytime by just going to, let's send another one. All right, there we go. Okay, so you just go to the webinars page, powerup.com/webinars.asp. You'll be able to click the Watch Live Webinars link, and that will give you a ability to see the calendar of the upcoming events. You can register for next week's follow-up presentation as well. Sorry about that, folks. All right, and for those of you that are curious, I just want to talk about the subscription services. Our Power Options subscription services, our 20-minute delayed service, gives you access to the tools and the 23 strategies plus the portfolio tools and all our signature tools. That's only $60 per month. We do, of course, offer a service where the 20-minute delayed plus the historical backtesting tools, and that's $100 per month, so $40 more for the historical view. We do also offer a real-time subscription, so every time you refresh the page or you run a search, you're getting the numbers and calculations at that very instant. That's $100 per month. And of course, the upper level of service, the real-time service plus our historical plus the API is $140 per month, so $40 more than the real-time service as well. Well, ladies and gentlemen, I didn't see any other questions come in during today's presentation or at the end there. I want to thank you for joining me for this introduction to vertical spreads. I hope to see you next week for our discussion on managing the vertical spread positions. If you think of any questions later on, please feel free to send me an email to support@powerop.com. And remember, you can call us toll-free during market hours at 877-992-7971. If you live outside the continental U.S., you can reach us at our international line. It's 302-992-7971. Of course, there's contact links at the bottom of every Power Options page. John says, thanks for the presentation. Nice presentation. See you next week. Sounds good, John. I'll see you next week as well. It'll be a good time. We're going to have a lot of good management discussions there on the different spread positions. Okay, well, ladies and gentlemen, thank you once again. This webinar will be recorded, as I mentioned. It will probably be posted around 5 or 6 o'clock Eastern Time this afternoon, and you can locate it right there at that link I sent you, www.powerup.com/webinars.asp, and you'll also be able to register right there for the upcoming presentation next week on managing spread positions. Take care, everyone. Have a great trading week. We'll see you soon. Good night.